Hey everyone, welcome back to Corporate Decoder. Today XPD just filed an 8K report and I am seeing some interesting shifts in their business strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is talking a lot about technology, especially AI, and some behind the scenes restructuring that might impact its long-standing policies. Alright, let's dive into what Expeditors International of Washington Inc. shared in their latest filing. This report, filed on the 11th of August 2026, gives us a look at their current business situation. A big part of this filing is what they call Regulation FD disclosure, which essentially means they're sharing important information with everyone at the same time. They've included a section called Safe Harbor for forward-looking statements, which is basically a legal way of saying that when they talk about the future, things might change due to risks and uncertainties. They're pointing out that this information is based on their current expectations, but things could turn out differently. Now, the most interesting part of this filing is a Q&A session they've included. It is like getting a direct update from the company about what is happening on the ground. First up, they're addressing the strength in air freight rates and volumes, which have been better than expected. They explain that the conflict in the Middle East has impacted air travel, but it hasn't affected every route equally. The biggest impact has been on the availability of cargo space, not necessarily on flights being cancelled. They've seen strong growth coming from Asia, which wasn't as affected. This growth is thanks to existing customers shipping more, them gaining market share, and a big boost from the technology sector, especially with AI. They mentioned that AI demand seems insatiable and is really straining the current air cargo capacity, which could lead to higher prices for longer. They're seeing these high growth rates continue into the third quarter. They go deeper into how the Middle East conflict affected air cargo because of airspace restrictions and the need for carriers to carry extra fuel. The actual amount of cargo that could be carried on flights decreased. This tightness in capacity helped keep prices high. Again, they highlight that most of their growth came from Asia, which was largely unaffected by these issues. They're seeing this healthy demand continue into the third quarter, but they caution that future pricing will depend on how quickly capacity returns, carrier decisions, global events, and whether the demand for technology-related shipping stays strong. Their business model, not owning the planes themselves, gives them flexibility to adjust quickly. When asked about the specific impact of AI infrastructure and data center shipments, they state they don't share exact numbers for individual customer types. However, they confirm that demand from AI hyperscalers and other tech customers was a significant growth driver. They expect this demand to remain strong for AI infrastructure deployments and note that air carriers are under significant strain due to geopolitical issues, rising fuel costs, and tight capacity. Regarding the sustainability of these strong results, they acknowledge that market disruptions play a role, but their success isn't just from temporary events. They achieved double-digit growth across most of their services from various regions and industries, driven by gaining market share and strong execution. They believe they may benefit more during times of disruption, but they're always preparing for the unexpected. On the question of whether hyperscaler demand is slowing, they say they are not seeing any signs of it. This business, especially in air cargo and customs brokerage, was a key part of their growth. They believe they are actually gaining market share in this space because customers recognize their expertise in handling high-value freight. This is where things get really interesting. They've undergone a restructuring within their global technology organization to modernize it for the future, aiming to align with their long-term tech goals, improve productivity, and position for growth. They're not giving out specific details about which teams were affected. Now, about their layoff policy. They clarify that while they've historically avoided layoffs, especially during tough economic times like the 2008 financial crisis or the COVID-19 pandemic, they've never had a formal or blanket no layoff policy. They admit they have occasionally reduced our workforce through layoffs for very specific strategic reasons. They emphasize that their culture remains strong and is crucial to their success, and they wouldn't have done this restructuring if they didn't believe it was in the best interest of the company's future. They further explain that this restructuring is not changing their technology or AI ambitions, and it wasn't about cutting costs or shifting to outsourcing. Instead, it was to better position their global technology team for future needs by modernizing legacy systems and practices. They reiterate that, while unusual, layoffs have happened before for strategic reasons. They believe this was the most direct path to continue investing in technology talent and solutions. They are committed to developing strong internal technology expertise, but will selectively use third-party solutions where they add value. Shifting to ocean freight, they see encouraging signs of stabilization. Ocean volumes increased sequentially from the first quarter, which is the first such increase since the third quarter of 2025. They also observed the prolonged downturn in the ocean market flattening out due to stronger demand and careful management of shipping capacity by carriers, which led to improving rates, especially towards the end of the quarter. They also note that their comparisons to previous periods will become much easier in the third and fourth quarters of this year. In their customs brokerage and other services, there was a slight compression in the profit margin. This is mainly due to a shift in the mix of business. While all their services grew, their road freight, warehousing, and distribution services were particularly strong. Because road freight has a lower profit margin than customs brokerage, this faster growing part of their business brought down the overall profit margin percentage, even though the profit from the customs business itself improved. They don't see a clear peak for customs growth. They believe that as tariffs, regulations, and cross-border compliance requirements become more complex globally, there will be a sustained demand for customs expertise. The challenge for them is to scale their operations profitably to handle this increasing complexity, not just process more declarations. They're focusing on using expertise, data, and technology to manage this complexity more efficiently. Their operating efficiency improved to 32.2% in the second quarter, even with a $25 million restructuring charge. The restructuring in their global technology organization is expected to save about $50 million annually, with most of the job cuts happening in the third quarter. They believe there are more opportunities to improve productivity through ongoing investments in technology, artificial intelligence, better processes, and operational execution. These improvements are expected to be gradual over the medium term. Their long-term goal is to grow revenue without needing to grow headcount at the same rate. Looking at the bigger picture, Expeditors International of Washington, Inc. is navigating a dynamic global logistics landscape. The company is clearly leaning into technology, especially AI, as a significant growth driver and a way to improve efficiency. The restructuring within their technology department and their candid explanation about their historical approach to workforce management suggests a strategic move to adapt to future demands. While market disruptions like the Middle East conflict have boosted recent airfreight performance, the company is positioning itself to benefit from long-term trends like increasing global trade complexity. The key will be how effectively they can leverage their technology investments and adapt their operational model to sustain growth in both air and ocean freight, while managing the evolving needs of their customers, particularly in the high-demand tech sector. Overall, Expeditors seems to be making proactive adjustments to its strategy, focusing on technology and efficiency to navigate current market conditions and position for future growth. The AI-driven demand is a powerful tailwind, but their ability to manage capacity and costs effectively, especially with the ongoing restructuring, will be critical to watch. That is my take. Stay decoded. If you found this analysis helpful, please hit like, subscribe, and join our Discord for more discussions.